Hi, this is Phil at the Laptop Trader Channel on YouTube. Welcome back to our community. Caution: most stock traders lose money. Please protect yourself at all times. Nothing discussed in this video is trading or investing advice. This channel is for information purposes only. Please seek qualified help if you need help investing. Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in markets. So this is going to be chapter 3 of my stock market basics series. This is for newer investors, newer traders. I hope you find it informative and helpful. This is our agenda for this month in March 2024. I'm going to cover what's the 40-40 plan, um, forward-looking markets versus past earnings per share reports, what is the bid-ask spread, what is stop hunting, trading, why take $5 to $10 risks to start, how am I going to make any money, when to sell in trade management, why I prefer technical analysis, should I use chart indicators, what is directional bias and an action time frame, quickly, is this a good trade, buy, add, sell, or hold? And then finally, at this point, after this presentation, you should have an idea if you even want to do the work to be a trader. It does take work. So what is the 40-40 plan? The 40-40 plan is very simple. Work 40 hours a week for 40 years and save and invest 15% or more of your income in your employer's sponsored retirement plan. This plan really works when invested in growth stock mutual funds and or a pension plan. I personally have known over 100 associates who are very well off and comfortable in retirement with over 1 million or more in assets. When combined with paying off your home and other debts, Social Security, personal savings and stocks, you should have enough income to stop working at some point. It works due to compound interest over time. Check out the compound interest calculator at investor.gov. I personally am in this plan and expect to retire. So how is the stock market priced anyway? This is one of the most confusing topics to explain, and the media and our education system is not helpful in doing so. In my opinion, there are three main aspects to pricing of stocks and the stock market in general. We have to understand that the stock market is a forward-looking price discount auction marketplace. The price you pay today is for some sort of future value, which is subjective, and stocks are expected to appreciate over time. So first off is supply and demand. Price is king. The more desirable and popular a stock is, the more people are willing to pay for it. This causes stocks and markets to be bought at higher prices and causes price appreciation. The reverse is also true. More supply and less demand causes falling prices. This part of the pricing is easy to understand as it is no different than a retail store product or durable good you purchase. In general, a can of Coke is more valuable than a can of generic cola. It is even more valuable if it is in a convenient vending machine nearby and you are thirsty. 2. Valuations of stocks based on future earnings and profits. This is more subjective as I may find value in one company and you may not. For example, I did not find much value in Apple when they first introduced the iPod and the iPhone. Most other consumers and investors, however, thought otherwise. and Apple prices kept going up. As Apple became more popular and accepted, they were able to charge more for their products and their brand, adding value to the stock and for shareholders of Apple stock. It did not matter what I thought of Apple. Now, the real confusing part is when, for example, Apple stock price today is, let's say, $100 per share. That value is some multiple of future earnings per share. It may be 10 times or 30 times or 100 times future earnings or whatever all participants in the market combined accept at the time. So, what if you do 2 hours of homework and you think the stock should be priced today at $75 per share? You really have only two choices to pass or play at today's price of $100. You can accept that price or wait to see if valuations come down for you. Companies can also manipulate or improve their financial metrics or the fundamentals of the company. They can improve sales, profits, net margins, come up with new products and services, expand to new customers, etc. This should increase earnings per share, abbreviated EPS. One trick often used nowadays is buying back shares. This accomplishes increased earnings per share because there are less shares available, even if real earnings did not increase at all. So just some quick math on how this works. Let's say a company has 1 million in earnings or profits divided by 1 million shares. So that's easy. That would equal $1 in earnings per share. If the leaders of the company decide to buy back 100,000 shares, we get an increase in earnings per share even if the business did not grow. So using the same numbers, 1 million in earnings divided by 900,000 shares equals $1.11 earnings per share. A few notes on this is most major companies will continue to grow at some rate, even if it is slow. This practice is generally looked at as positive for shareholders as it increases the value of each share along with stock price growth. The reverse is also true. If a company continues to struggle and needs to raise capital and issues new shares to the market, it is generally looked at as negative. This is called dilution, as it devalues the share price. Uh, this is out of your control, and so I would not dwell on it. Just be aware of it and understand sometimes earnings per share and earnings reports can be manipulated in the short term to boost profits or hide bad news about a company. A few of the best ways a company can grow are to grow sales, attract more customers, improve net margins by increasing prices or cutting costs, and coming up with better products and services. When you combine a well run business with buying back shares, it is overall a positive for investors. The ratio for this is the PE ratio, or the price to earnings ratio. An example may be 22 to 1. In general, supply and demand are more important than the PE ratio. So today's closing price of Apple was 170.73 per share with a PE of 26.32 and a market capitalization of $2.636 trillion. Today's closing price of Nvidia was 875.28 per share with a PE of 76.84 and a market capitalization or market cap of $2.188 trillion. So those two are a little bit different, right? Recently, NVIDIA has been bought up to this higher valuation as reflected in its higher PE ratio. In other words, investors have been willing to pay higher and higher prices for the stock, while earnings, even if increasing, are not keeping up with the future valuation. You could see that Apple is worth more in dollars with a lower share price and a lower PE ratio, thereby, in theory, being a better value at today's price. So the big question is, which is a better investment? Well, that depends on your outlook for either company and can they increase profits and earnings. But the main factor is if you own either stock, what price did you pay for it? Price is king in the markets. For example, what if you paid $100 per share for Apple and have a nice profit? As today, Apple's at 170.73. What if you paid $100 for NVIDIA and have a really nice profit, with NVIDIA closing today at 875.28? So, in my mind, this is what matters most because the two main ways to make money in the market are price appreciation and dividends. There are other ways, but let's keep it simple for now. 3. Current valuations after an earnings report. Have you ever watched the news and they report a company made or lost a large amount of money in one day? Maybe something like Apple just lost 500 million in market cap today. Usually these reports are a reaction to some company news or an earnings report. As Wall Street investors price companies for future earnings as reflected in today's price. An earnings report is what has happened in the past 90 days in general. Most companies report earnings every quarter or every 90 days. Think of this as when you were in school and your parents expected A's on your report card and you reported B's and C's on the report. Wall Street always expects the best and growth and higher profits. The higher a stock becomes valued, the harder it can be to meet those expectations. Many times companies won't meet these expectations, or even if they do, it simply is not enough to maintain today's prices, and the stock gaps down on earnings or sells off considerably over the next days and weeks. So all of this has to be taken in context of other market factors, such as a slowing economy or some other national event. It is natural for markets to go up and down as a cycle, and so you should also expect that. This is also why you may have a good earnings report and the stock still goes down. And I have an example of that later in this presentation. Sometimes it may not make sense, and so you need to protect yourself at all times, either with risk management and or diversification over many stocks or mutual funds. The opposite is also true. Many stocks can be bought up to new highs for virtually no known reason. Again, price and supply and demand outweigh valuations in the short term. So let's review the main reasons for stock prices. Supply and demand for the stock. Price is king. Future valuations for the market and the stock. These are the expectations for the company and the market. So the stock market is a future value and a current discount model. Current valuations are based on past earnings, which is the report card every quarter. I hope that helps explain what sometimes looks like nonsense or euphoria or why did that happen. And remember, do not forget, what did you pay for it? Do you still have a profit? So as two final examples to look at, let's take a look at NVIDIA as one that is higher and Hershey that has been sold off over the same period. So is NVIDIA really worth 8 times what it was a year ago and Hershey worth $100 less per share than it was a year ago? I am not so sure, as people still eat chocolate and we need semiconductors in the modern world, but it seems excessive to me. As a final note on PE ratios is that they do not seem to matter in an uptrending bull market environment that much. Then, when the market turns down to a bear market, all of a sudden investors become concerned with future PE valuations because they may have overpaid for a stock. PE ratios don't seem to matter until they do. There are other metrics or ratios to consider when it comes to valuations, such as price divided by cash flow, or price divided by sales, or profit margins, or net income, or revenue growth, or return on equity, and others to get a full picture of a company's performance over a period of time. So I just don't want you guys to think that PE ratio is the be all end all. It really isn't. It's just something to consider. For me personally, I do not spend much time on the metrics or the fundamentals of a company, as I believe most of this information is already priced into the current stock price. I am not that smart, and there are full time paid analysts on Wall Street who apply fundamental valuations and quantitative analysis to companies. Large institutions pay for this information as to give them an idea of when to buy and when to sell. I simply watch the price charts and follow the leaders when they buy and sell and time my entries and exits. I'm not looking to buy the bottom and sell the tops. I'm simply looking to make money and get a good return on capital for my risk. So now let's cover what is the bid-ask spread. So this is the difference you pay between what you buy a stock for and what you sell it for. This is how market operators make their money in offering the exchange services to you. They make pennies on millions or billions of shares traded. They make money on volume, and you make money on price movement over time. They make money whether you do or not. It is their business. So today, as an example, Carvana had a closing price of 85.30 per share. Bid ask is 85.06 by 85.54. So 85.30 would be considered fair in the middle of that range. If you needed to sell quickly, you could enter a bid to sell at 85.05 and your order should be accepted. If you are anxious to buy, you could enter an order higher than 85.30 and your ask or offer should be accepted to buy. Most times I use a limit order to enter and exit my positions. The more liquid a stock is, the tighter the bid ask will be, sometimes only 1 or 2 cents wide. This reflects the size and popularity of the company being traded. So it's just something to be aware of. The bid-ask spread is one of the reasons most traders stick to larger stocks and avoid the smaller companies or penny stocks on the American Exchange or the OTC, which stands for over-the-counter stocks. These smaller cap stocks can have wide spreads and be illiquid and hard to get out of if you need to sell quickly. I am not saying don't buy or trade small cap stocks. I am saying be careful with what you buy and how much exposure you have to something that is not very liquid. They will let you buy it at market prices, but if price gaps down, you may have a hard time selling and or be stuck with it. Watch your overall risk and be aware of the bid ask spread. This also leads me to the topic of market manipulation and stop hunting. It is much easier to manipulate the price of smaller stocks. It is technically illegal, but does happen and is out of your control. In my career over hundreds of trades, I believe I have been stop hunted maybe 5 times. Every time it has happened the same day, I entered a trade, set my stop, and stopped out usually the same day or next day. I think what happens is we forget to consider a wide bid ask spread. Let's say 50 cents, and we buy higher at the ask, and another operator essentially steals our shares for the bid price at 50 cents less per share based on our stop loss near the bid price. It is basically legal for them to do that because you set your stop near the bid, and if the price falls and your stop is within that range, then yes, they can buy your shares from you, even if the current market price does not reflect that. It can be confusing, but it does happen. I suggest sticking to stocks on the Nasdaq or the New York Stock Exchange or the S&P 500. You can also play the smaller stocks with a larger stop loss or no stop loss and stick to a low overall exposure that you can tolerate. Always use risk management. This brings us to the next issue of how much risk should I take? Well, if you are a mutual fund investor, then your risk is spread out over a large basket of stocks anyway. So really, this is out of your control. I never used a stop loss on my investing in funds, nor did I know how to use one. If you are a new stock trader and have little to no experience, then I suggest you use $5 or $10 risk using a stop loss strategy to start out. Why? Because you have no experience and you do not understand the financial dangers of exposure to individual stocks yet. By using low risk, you can cut your teeth over the next 100 trades so you can start to gain some experience and then evaluate how you performed over your first trades without throwing away your hard earned money. If you took 100 trades and stopped out on every one, you would limit your losses to about $500 to $1,000. If you pay attention to what I and others are teaching you, you should not lose every trade. My three main risk rules are: position size is a dollar amount or percentage of your account. Maybe start with 5% or 500 per position. And then share size per your risk value, let's say $5. If you use a 50-cent stop loss, you could trade 10 shares of that company as long as it is not over rule number one. Finally, have a trading plan so you choose or select appropriate stocks or technical setups you are confident will perform as expected. Use a pre-trade checklist to verify the information and track your trades. Track your trades using paper or a spreadsheet as to how you performed. Then, after 100 trades, you can evaluate what you did good or bad and adjust your risk accordingly now that you have something to evaluate. When I first started working on cars, day one, they gave me simple tasks like changing oil and rotating tires. Then, as I proved myself, I moved up to electrical problems and battery and charging systems, then moved on up to engine diagnostics and repairs and ABS systems. It is the same thing in the markets. If you are new, don't just jump in and expect to be successful. So this will be a quick just overview on trade management and when to sell. This will not be comprehensive. I could probably make a whole video on trade management, but this is yet another reason to start small, as this is more based on your personality and your tolerance for risk and how patient you are. This was difficult for me to get used to as there are quite a few variables. This will become part of your trading plan over time. I generally won't even consider entering a trade unless I can see at least 2 RV on a chart, preferably much more. So if I'm going to risk, let's say 50 cents per share, I want to make at least $1 per share or more. Then if I get to that target, I have a decision to make. Sell and take profits, sell some shares, like half my shares, and let the other shares stay to make more money, raise my stop and add shares to a winning position and maintain the same risk. If you are patient like me, you may choose to stay with it and just raise your stop to lock in gains. If you are a more nervous or a day trader, you may want to take all profits and move on to the next trade or trade the next day. This is where gaining experience slowly helps you tune your personality to the realities of trading stocks. Trade management is where the rubber meets the road, as it can play with your emotions. Let me explain with a few scenarios. What if you enter a stock and it goes to target quickly and you don't do anything thinking it is the start of a much bigger move? Next day it gaps down and stops you out for a loss. Now how do you feel? What if you identify a stock with a good risk to reward and it goes to target and you sell at target and you had a good trade? The next day it gaps up 20% on some industry news and you think, what if? What if I would have held? How do you feel now? You feel like you left some money on the table, maybe? What if you enter a stock and you set your stop and it stops you out the same day, only to see the stock close up 10% the same day? How do you feel now? Was that a good trade? What if you enter a stock with a good risk to reward and it looks like a tight pattern that could break out to new highs? You hold the stock for a week and it is just not moving, so you exit the position. Next day it gaps up and closes higher for the day, higher than your target that you had identified. It would have been a 4R win, but you got out. How do you feel now? Was that a good trade? When to sell is not a clear-cut answer, and it will take some practice and some patience for you to figure out for yourself. Also, it may change over time as the market environment will change. For example, the bear market of 2022 into 2023 is a different environment than the current bull market of 2023 to 2024. You may not even want to be in the market at certain times for various reasons, called sitting on your hands or SOH. For me personally, at times I have been too patient and allowed my gains to retrace to losses in some cases, and allowed some losses to go too far, thinking it will come back. That was the wrong thinking for me. It is your money and your choices which will lead to success or failure in the stock market. There really is no one else to blame. In fact, your greatest enemy is not the market or market makers or hedge funds or high frequency traders or black market traders or short sellers. It is you and your trading approach. You can either accept that or not, but that is the truth. I prefer technical analysis using price charts for two main reasons. One, I am a visual learner, and if I can see it, I can understand it, or I can fix it like a repair on a machine or a car. I can see price on a chart. Two, price action is true. It is what is happening or has happened, despite any other opinions or news or dialogue on valuations. Let's look at a few charts for examples. As we can see on this chart of Akamai Technologies, symbol AKAM, looking left to right, we can see price was in a downtrend and price changed direction to an uptrend. Recently, a few weeks ago, there was a large red selling bar, a wide range bar, indicating a lot of selling all of a sudden. It does not matter what an analyst thinks or says at this time, the stock is being sold. The stock, the stock gaps down the day of earnings and gaps down significantly the next day, then sells off over the next week. That happened after reporting good earnings of $1.69 per share on estimates of between $1.10 and $1.26 per share. What happened? Well, if you read about the report, you find out that management lowered their expectations for the future, saying that future growth and earnings would slow down due to their customers renewing their contracts with this company. Remember, Wall Street pays up now for future performance. Sometimes current and past results, the report card, do not always mean higher prices due to expectations in the future. Even though current performance exceeded past expectations, future expectations did not meet Wall Street investors' expectations going forward. Therefore, the stock sold off. So it's not always cut and dry when stocks go up or down. Let's take a look at that chart quickly. This is a 2-year weekly chart, meaning each bar is 1 week of price action. Each candle or bar is 1 week. You can look at that chart looking left to right, where price was in a downtrend right here. All right, downtrend, downtrend. Then it kind of switched up and went into an uptrend. And then you can see right here, this E is earnings. This big red bar is a big sell-off after earnings. So that's true. That's what happened. Then if we look at a daily chart where each candle or each bar is 1 day's worth of pricing, we can see we had good earnings per share of $1.69. The price of the stock gapped down the day of earnings, and then it gapped down again the day after earnings and closed lower. And then it continued to sell off for the next 5-6 days right there. So you had a pretty good sell off right after earnings, indicating Wall Street did not like that report, even though the current earnings per share beat past estimates. So these things happen. I just want you to be aware of it. It happens all the time. See here, I just copied this from a website showing what their earnings expectations were. Average was $1.17 per share, and they reported $1.69 on February 13th. It's a company that makes money. They have annual net income of $548 million per year. And they have a market cap of, looks like 16 billion. So it's not a super small company, and they do make money. Next question for many new investors or traders: should I use indicators on my charts? I don't personally, as they did not seem to help me sort out what was a good trade for me. Let's look at Apple with my normal chart I use. This is a 2-year weekly chart. Each candle or bar is 1 week of pricing. I use 2 simple moving averages and volume below. That is it on my charts. I use a 10 and a 30 period moving average. Simple. So it looks very similar to that chart of Akamai, right? Same setup, just different company. See, Apple was in a bit of a downtrend, then it went into uptrend, and now it looks like it's kind of topped out, maybe rolling over into potentially a new downtrend, or at the very least, price is at the bottom of a trading range. So let's continue on with a chart showing indicators. Let's look at the same chart with some added indicators. Indicators are chart tools that are supposed to help interpret price and or volume and other factors to help you make a decision. There are hundreds of them, and in my opinion lead to confusion. If they are based on price and volume, why not just learn to read price and volume? If they work so well, why are there so many of them? What about a moving average cross strategy? I've tried that too and was always late to the party or late to exit, as moving averages take time to react to price movement. So that did not work for me either. So this is the same chart of Apple with some additional indicators on the chart. On this page, I just put on a couple. I put on what's called Bollinger Bands, which is like this shaded area. It's supposed to give you kind of a what would be overbought or oversold type of deal. And I also put on here the PPO indicator, which is a percentage price oscillator, which is this blue indicator. And so it just looks like a mess. Then I added some indicators underneath. I actually had to take 2 pictures to get all this. And this is another form of an oscillator. This is an indicator here. This is another indicator showing, overbought and oversold. This one on the bottom, called the MACD, stands for a moving average convergence divergence. This is a very popular one that traders use, and I guess when these cross, or it's blue or red or whatever, you're supposed to buy or sell. So I added several for you and had to take 2 pictures to fit them in this presentation. So PPO stands for percentage price oscillator. I showed you the Bollinger Bands. MACD stands for moving average convergence divergence. I even put on there an accumulation distribution line, the Williams version. I guess there's other versions of that, showing whether a stock is being accumulated or is under distribution and being sold. And there was the Arun oscillator. There's hundreds of oscillators. And I put on there a force index. I don't even know what that is. And underneath all that is the original price chart, which you couldn't even see after I put all those indicators on there. Can you make heads or tails of that? I can't. I've tried it before and it didn't help me. Now, if you want to use 1 or 2 indicators, fine, but adding more just adds to confusion in my experience. So again, I use price, I use price candlesticks, I use volume on the bottom, I use a couple of moving averages is all I use. One of the reasons there are so many indicators is so that the inventor of the indicator and the company using it can make money selling it to you, selling you the holy grail of technical analysis. So I think that's why there's so many of them, because somebody was making money off of them. Now let's talk about what is a directional bias and an action time frame, or a directional time frame and an action time frame. So a directional bias is a higher time frame to give you a possible market or stock direction or price direction. Is the bias higher or lower? I use the month or week for my bias time frame. An frame you enter and exit your trades with. I use the daily chart for my entries and exits and stops. Sometimes I will use the higher time frame for higher potential targets and profits. Let's look at Amazon as an example. So this is a weekly time frame, so this would be 2-year chart. This would be my bias. So in this case, I think it's pretty obvious that Amazon is in an uptrend, right? Looking left to right, price is going up, so indicating that there's an uptrend here. So my bias would be for higher prices. So on this chart, maybe a potential target would be the next number here of $200. And today, price is at 175.35. Then if we go down time frame, we go to a daily time frame, we can see that it looks a little bit different. So this is the data is expanded, and we're only seeing the last 3 months on this daily time frame. And we can see right here we had earnings. We had a positive reaction to earnings. Since that time, prices kind of consolidated here in this area just over the blue line, which is the 20-day moving average. So this looks still bullish, right? It's just kind of consolidating, maybe even moving up just a little bit. And so if we bought here, let's say over this bar, and placed our stop somewhere under here, I think you guys can see that we can get a pretty good risk to potential reward. In this case, maybe we put our stop at 170, buy at maybe 176, maybe get a $5 to $6 stop loss, with our potential being up here off the chart at $200. So I think you can see that could be a potential maybe 4 or 5 or even 6 to 1 risk to reward on a stock like Amazon. So that's just a quick lesson on how to use a bias time frame and an action time frame, and how I would use that in my approach. Again, as we can see on the weekly time frame, Amazon is in a clear stage 2 uptrend, and I would expect that to continue. So my bias is for higher prices. Also, Amazon is making new highs. And on the daily time frame, it is also still in an uptrend in agreement with the higher time frame. I would enter Amazon expecting the trend to continue higher. I would look for a smart entry with good risk to reward and a price pattern of some sort for an entry. The lower time frame you are trading will not always be in agreement with the higher time frame. That is okay because it can still be a good trading opportunity. It takes practice, but can be confusing, so stick around. Right now, Amazon is consolidating on the daily action time frame, setting up nicely for a potential next move higher. So it's kind of like when you see a stock consolidating like that, it's kind of like pressure is just building and the stock is just kind of resting. And similar to somebody that maybe runs a lot, runs a long distance, and then has to take a rest. Well, you because Amazon has been in such a nice uptrend, it's just taking a rest right now. So if we bought some shares at 175 and placed our stop at 170, and the price moved up to 200 or more, that would be a good risk to reward if that happened. It'd be about a 5-to-1 risk to potential reward, so not bad. How quickly can you make a decision on an investment? This is going to come down to personal choices. It really doesn't matter how quickly you can make a decision on investment, but it's up to you how much time you really want to spend on analyzing companies. And it's going to depend, are you an investor long term and want more information or ratios or other reports, or are you more like a day trader on the opposite end of that? Most investors want to buy and hold for a longer period of time, and a day trader wants to get in and out quickly for profits. So it's just two totally different thought processes. It used to take me quite a long time to decide, and I was nervous to gamble my hard earned money. Today, I can make a decision to buy, sell, or hold in under a minute. I just don't dwell on it anymore, mostly due to risk management and trade management that I learned. Because I know if something doesn't work out, I covered my bases up front before ever entering a position. No investor or trader is perfect, and even a good trader may bet 60% on winning trades. So, they win 60%, but they're losing 40% of their trades. That would actually be considered a good trader. So have fun taking your losses. It's part of the game. I think that is enough for chapter 3. I hope it was helpful to you and informative. At this time, you should know whether or not you want any part of investing or trading in stocks or ETFs. You may want to just keep your job and continue on with the 40/40 plan. And there's absolutely nothing wrong with that. In fact, that is appropriate for most people. It is pretty safe to keep your job and invest in mutual funds through your employer 401k plan. If you want to continue down the rabbit hole with us here at Laptop Trader, you are welcome to do so. We have new videos every month for our subscribers. There are many types of investors and traders, and only you know what is appropriate for you. You can buy and invest in individual stocks for the long term. You can swing trade, position trade, day trade, and many other options are there for you. I consider this subject a lifelong experience and learning, and I hope you do too. If you enjoy new challenges and learning new ideas, then trading may be for you. If not, then I sincerely wish you the best of luck, as trading is not for everyone. I can only say that for me, the experience so far has been worth my many hours of study. It was not always easy or comfortable, and it took me some time to gain the ability to learn this profession and gain confidence. My first trade was 10 shares of an $8 stock, and I was so nervous. Today, several years later, I am comfortable trading $200 or $300 per share stocks. If I can do it, so can you. See you next month. From Phil. Email laptoptraderphil@gmail.com.